Birla Sun Life Mutual Fund's ambitious annual event, Voyage Navigate 2016, took place in Mumbai recently. The event had a stellar lineup of speakers, both international and domestic, to share their valuable insights and knowledge which will help investors to invest wisely for the long term.
Ladies and gentlemen, it's my pleasure and honor to welcome you to the third edition of the Birla Sun Life Mutual Fund Presents Voyage Navigate 2016, powered by ET Now. Ladies and gentlemen, please put your hands together and join me in welcoming the CEO of Birla Sun Life Asset Management Company, Mr. A. Balasubramanian.
So I'd like to thank each one of you for taking time out from your busy schedule and attending our event in Mumbai. I'm informed that out of the total participants of 9 today, we have about 950 people. More than 450 people have come from over 110 unique locations outside Mumbai. And thanks to all of you for gracing this occasion today. We do meet with all of you around the year in different formats. However, Investment Voyage conference is something unique to Birla Sun Life Mutual Fund. Not even Birla Sun Life Mutual Fund, even the mutual fund industry. We are deeply committed to you, our partners across the country, in giving you the best experience possible in enriching your knowledge. So this year, our concept for Investment Voyage is Navigating 2016. And since 2014, unprecedented developments have happened. Commodity prices have, of course, fallen to an unimaginable level. The regulatory framework across the world is undergoing a change. We have to accept that. And most of the big nations are battling challenges of their own issues. However, India seems to be the one in a good wicket. And integration with the global economy has become so seamless. We continue to react negatively or positively as it suits. And despite such enhanced linkages, India continues to remain one of the big destinations for FDI flows among the emerging market. Therefore, we have lined up today's sessions in this context and the background. Our endeavor over the years is to build a franchise that is capable of managing money across asset classes, including mixed assets. I am proud to say that with your support and wishes, today we have built the desired capability and have delivered performance across market cycles. We do have created array of funds, both in fixed income and equity, which are time-tested and has proven track record. In order to support the journey of growth, our consistent investment performance continues to be the backbone of our business. I always keep discussing internally that we are an asset management company, therefore we should manage your money much more effectively. If we do that, we will be able to provide a consistent investment performance. In an aggregate basis, BSL AMC had a number of funds in the 5-star category of Morningstar and CPR 1 and 2 category from Results. The number of funds were pretty high, even compared to the competing world. In our endeavor to grow our customer base, we have taken up our industry education initiatives very seriously. And we will continue to conduct on-ground activities in order to expand the market across the country and around the year. We also progressed quite well in building our digital capability. I'm happy to inform you that we are the first AMC to go for eKYC for onboarding of customers using Aadhaar card. And in order to expand our business, we are now opening about 30 more branches this year, taking our total branch in which we operate about 140 or so. And by end of this year, given the point of presence that we are creating to the MR model, we will be operating about 180 locations by end of the year 2016-17. I would like to end by saying we remain humble and stay committed to build our business with wonderful partners like you, and we remain focused to have events like today, year after year. The another two things which I just want to highlight, so I always look at coincidence. And coincidence should always give us a positive energy. And as we all assemble today, the two indicators that has come, and both of them are positives, which is dipping of inflation and rising IIP numbers. So that I call it as a coincidence, which essentially means it does indicate in the beginning of the new year, yes, something is a positive sign to look at. The another coincidence I always look at, which is a message which I send to all my employees across the country every day morning at 8 o'clock, which is a thought for the day. There is one thought which I think it came today, which I just want to read out as it is. It has been communicated to all my employees, which is nothing but complain less and breathe more and criticize less, create more, worry less and laugh more. And I'm sure with this kind of approach, we can take the industries to much bigger level. Along with that, we can also take the Birla Sun Life AMC to a much bigger level in the years to come. Thank you all for coming.
Mr. Balasubramanian, can I request that you please remain on stage? Because at this point, we'd like to kick off an interactive discussion and dive a little bit deeper into some of the insights you've shared. And to help us do that, now I'd like to call upon stage ET Now's Chief Editor of Financial Markets, Mr. Nikunj Dalmia.
Now, Bala, if I look at the current market, it is just like a Hindi movie. It started we started the year with a lot of hope. Then we lost our way. Things are looking up. So what lies ahead for the year?
Having been in the market association for so many number of years, we don't have much choice but to live with the hope. And the hope, every year it comes and goes, and we turn bullish, we turn bearish. At the end of the truth always lies on the outcome that we see over a period of time. There needs to have an optimism, there needs to have a hope, and I think we have to live with that kind of mindset.
How does one judge the current market volatility? Because markets have been crazy. We've put behind us a quarter of extraordinary volatility. Last 15 years of my television career as a market commentator, I've never seen such a quarter where we've seen a classic V.
Yeah, I agree with you that volatility is something which is now become a part and parcel of every market, every cycle. And having said that, I think the points that one looks at to draw in inferences to look at how the future could be, as long as I think they actually show an uptick in terms of showing an improvement in any way you look at it, and that should be the true indication that you should look at it. Also, one has to accept the fact that from a very high growth trajectory that I think the world has lived, and today nobody talks about high growth. I think people do talk about recession, and people do talk about that slowdown in some countries will be quite significant. There are people who have actually made significant money by selling oil at $100 plus, and they go through their own pain. So therefore, I think the cyclicality nature of every market, cyclical nature of every product, I think need to be fully understood. And if you start worrying for each of these cyclicality, I would probably assume that we will never be able to find an answer, because the answer is not known.
What should we, or what should your distributors, your channel partners expect from your AMC in this year? More market share gain, aggressive selling, more profits, higher commissions? There's a pause when you say higher commissions. Everybody pauses.
No, but we do believe combination of everything.
So commissions are going higher?
This is not a political answer, not a diplomatic answer. We do believe that it's a combination of everything. Even the last one what you mentioned, even commission can never be ignored. At the end of the day, everybody had to be paid for the hard work that everybody brings on the table. So there's a price that one has to pay for expansion. Having said that, I think Birla Sun Life mutual funds, the endeavor and the focus would be to build long-term sustainable assets. And that the mission happiness, we have a drive today. The mission happiness drive is nothing but increasing the advocacy of selling mutual fund, either by the investors or by the distributors themselves. Therefore, our focus is actually to build sustainable model, even if it may come at the cost of not getting some of our short-term growth to our satisfaction. Therefore, chasing actually the sustainability is more important than actually chasing the assets. And that's, I think, the culture that we are building in. That's why I think we are engaging with people across the country. That's one of the focus which we keep. I still remember there were occasions, post-2008, we were the only fund house actually went to the market and said that this is not the time actually to increase the exposure to one of our fund. And we said that we are going to put a stop. And the entire team in my sales, as well as some of the business partners, they said, why are you doing this? We said, no, we have to put a cap. And we also did a cap actually in one of our credit fund. But these are something we do it understanding where we want to take the business, the best interest of all shareholders, which in my view will give us the long-term sustainability.
Bala, before we start wrapping up today's interaction, if you have to, let's say, map this scenario, in 2015 we made a very strong case to buy into equities because the scenario and the terrain and the landscape was different. Today the landscape is also different. So for someone who wants to, let's say, lean towards the fixed income way or the equity way, where is the case strong? I mean, Manish and Mahesh, they both are great friends. and they will both make cases for the individual segments and asset classes. But as a CEO, you are in a position to give a very guided and give a very fair opinion.
I think interestingly, the beginning of every year, we do have a discussion, debate, the entire investment team. And this year too, we did the same exercise. And as you rightly said, there was of course different views coming from Mahesh, who has to of course create a bullish view on equity. And Manish was of course looking at the macro pictures and he was saying, but probably we'll see fixed income doing much better. And from business point of view, we will take a call. And then we came with the concept that this year is going to be a mixed assets.
Okay.
Not that it was not there earlier.
That's a pitch at this forum at today's event.
Mixed assets. Therefore, from asset allocations point of view, from every investors or whether it's you, me, or anybody sitting in this room, you cannot say that this one asset class is going to be the only asset class where I'm going to put money. Therefore, the mixed assets is going to be the key to the success. Not just only in building business, even actually giving the better satisfaction to the customers. And that's the outcome which came.
When manufacturers today have the option or distributors today have to sell the products of other manufacturers, why should they sell your products?
We stay committed to building the business. I always keep saying that working in one organization for 20 years is something actually the credit not goes to me, somebody has kept us. Right? That means they are actually looking at building the business for long term. Therefore, Birla Sun Life Mutual Fund, I always say, I am there, tomorrow somebody else will come. But mutual fund will continue for generation to come. Therefore, where will you trust? Will you trust the generation or will you trust somebody else? That's the question which I think investors have to ask this question.
Okay, so thank you, Bala.
Next up, we have the President and Chief Executive Officer of Sun Life Financial, none other than Mr. Dean Corner, who will shed some light on the Sun Life and Aditya Birla Group partnership and why it's a top business priority. Mr. Dean Corner, please join us on stage.
Namaste. Well, it's indeed a great pleasure to be here with you, Bala, with your colleagues, with your distribution partners here in the room and across India. It's a wonderful pleasure to talk to you about such an important topic. Sun Life first came to India in the late 1800s, and we operated an insurance business here successfully until 1956. And then when the opportunity came in the late 1900s to come back to India, we raced to come back to India and, in fact, sided up with Aditya Birla Group, which has proven to be one of the best decisions we've ever made. We've had a fantastic partnership founded on the same principles of doing business that Bala talked about. One is integrity, one is looking at the long term, making long-term investments. And when you think about our business, Sun Life, we just celebrated our 150th birthday as a company. 150 years, it's amazing. And how does a company survive and thrive for 150 years? Well, it means taking a long-term view, taking a long-term view of investments, taking a long-term view of relationships like the one we have here in India. We are faced with low for long interest rates and investment yields in most developed markets in the world. And why is that? You know the reasons. We've got aging populations in many markets around the world. So you look at Japan, you look at the United States, you look at Western Europe, aging economies where South Korea, another one, where people, as they age, spend less. You look at the advances in technology. So the ability to do it better, cheaper, faster is also reducing demand in many cases. You look at globalization. The ability to perform work in other countries is driving down the cost of that work and having a big impact, again, on demand and creating excess capacity in many markets. Excess capacity and a lot of capital swimming around the world looking for opportunities to invest. and a credit overhang from the global financial crisis. You put all that together, and we have the makings of low interest rates for long. One of the side effects of that is India and the interest of global investors in India. And it's obvious why. I mean, you've got an economy that's growing around 7%, real wage growth around 5%. You know, at that rate, the standard of living will double in 14 years. I mean, this is a, you know, in a world that's got pretty flat growth, India has a giant open for business sign, and the world is beating a path to your doorway. So that, over the long run, I think augurs very well for capital markets, for investment returns in India. It also suggests over time interest rates will come down as more and more capital finds its way to India and drives up prices and drives down rates of interest. So I think that's a real positive. The other positive is the underpenetration in terms of mutual funds. In the Canadian market, mutual funds as a percentage of GDP are around 60%. In the United States, it's around 90%. In India, I think it's around 7%. So the opportunity for the mutual fund industry to grow and play an ever larger presence and role in the investing lives of Indians is enormous. And as people slowly shift away from traditional stores of value, gold and real estate, and become more confident and more familiar through your help and advice with investing in mutual funds, I think that is very exciting. It's a very exciting time and a very exciting place to be. I want to shift and talk about the importance and value of advice, which is a subject that's near and dear to your hearts as leaders of distribution in India. We did a study a few years ago in Canada to try to demonstrate empirically the value of advice. And there's a comparison between households that have advisors, have a financial advisor, and are saving with an advisor, and households that don't have financial advice. And over a 7 to 10 year period, those households who had an advisor had saved, on average, twice as much as those who were trying to save without an advisor. And those households that had an advisor were able to generate average annual returns that were 300 basis points higher, net of fees, than the households who did not have an advisor. Why is that? How could that be? Well, you know this because this is your business. The first thing is, when you have advice and you have an advisor working with you on a regular basis, you see the value of dollar cost averaging, you see the value of regular saving, and you end up saving more than you otherwise would, and you put the money to work at the right time. The second reason is, and this is a huge source of value added, is in moments of volatility, in volatile markets, when the market falls, those who have good advisors don't panic, they don't sell, they hang on, and they ride through to the next curve, to the next transition. And that alone, avoiding the sale of mutual funds, avoiding the sale of your assets when markets bottom, is enormous value, worth its weight in gold in terms of the fees that get charged for that advice. You put all that together, as well as the wise selection of mutual funds and picking the right funds and picking the right managers for the long run, and there's strong empirical evidence of the value of advice. But I would say to you today, that's necessary but not sufficient. That we as an industry and you as practitioners have more work to do to demonstrate the value of advice to clients, to regulators, to the media, and to others. I want to tie this conversation around the value of advice to the digital world. So lots has been said about robo-advisors, and we have many examples of robo-advisors being rolled out around different marketplaces. I don't think that robo-advisors will ever replace personal advice. I went and set up a robo-advisor account for myself just to see what it was like. I put some money in. I'll tell you, it was easy to get the money in. I can go look at it on my mobile app. I can see what my money's doing. I haven't had a single phone call from them, even through turbulent markets. It'd be very easy for me to move my money out. I'm getting no advice around that money. And I think in the longer run, all the things I talked about, all the areas of value added, come through personal contact with a trusted advisor. Where I do think digital tools, though, will make a big difference is in addition to the advice, imagine a world where you develop a financial plan with your advisor. I'm here today and I want to get there tomorrow. And you file a flight plan. Here's how much I'm going to save. Here's how I'm going to invest. I want to retire at this future date, or I want to fund my child's education, whatever I'm saving for. And then every quarter, you get kind of a digital nudge that shows you how you're doing. You've got some tailwinds that have helped you get there faster. You've got some headwinds that have blown you off course. It's going to take you a little longer. Might be the reason to go in and talk to your advisor. Might trigger or nudge you to do something different. Might nudge you to start to save more. I think these digital tools, digital planning tools, digital navigation assistants will be a huge productivity boost to advisors as advisors service their clients and help their clients achieve their lifetime goals. Feeling great about all of the progress and help we've given to distributors, to advisors, and ultimately to the millions of clients who will have benefited from saving in your mutual funds. I can see that day coming, and I think it'll be just fantastic. When I stand back, and I'll just finish with this thought, when I stand back and I look at the mutual fund industry, and I look at the mutual fund industry in India, and I look at the mutual fund industry in India with Birla Sun Life Asset Management, you're in the right place with the right fund company at the right time. Good for you. Thank you very much.
Up next, we have Mr. Paul Danis, who's the Chief Strategist with the Canadian firm BCA Research. He is here with us to share his take on global macro fundamentals, where they've been and where they're headed. Please join me in welcoming Mr. Paul Danis.
Kicking off, with regards to our view on the global economy, we had a pretty sharp snapback in global growth following the initial exit of the global financial crisis in 2010. Since then, global growth has been slowing progressively. So we had 5.4% real GDP growth in 2010. That's moderated to 3.1% global real GDP growth last year, according to the IMF. So for this year, for the next few quarters ahead, we'd see growth not slowing substantially from where we are today, but we don't see anything in the way of a meaningful catalyst to push growth substantially higher. So with regards to the US growth outlook, we're seeing competing headwinds and tailwinds to growth. One of the big headwinds at the moment would be the CapEx outlook. Energy and materials, the resource sectors, are responsible for around 33% of CapEx globally. And sectors that are indirectly affected by CapEx, sectors like utilities, construction, industrials, also make up a good chunk of global CapEx as well. So given the big sharp fall we've seen in commodity prices, we'd expect to see a continued pullback in CapEx. We're seeing a deterioration in corporate balance sheets in the US. On the back of this deterioration in corporate health, we're seeing banks tighten up lending standards to businesses in the US. That said, we wouldn't think that it would make sense to be overly pessimistic with regards to the US economic outlook. Importantly, we don't see anything in the way of excesses built up in the US economy. So one way to gauge this is by looking at cyclical spending in the US as a share of potential GDP. Crucially, we've got a pretty positive view on the US housing market, and there's a lot of research that shows the way that the US housing market goes is the way that the US economy goes. Other supportive factors behind the US economy at the moment, we're seeing the dollar no longer strengthen. So this big upturn in the dollar since 2014 is starting to reverse. That should slowly have a positive impact on net exports and multinational profits. And just finally, the Federal Reserve is obviously in hiking mode. It's the only central bank globally that's hiking rates, but we think the Federal Reserve is going to take a very go slow approach with respect to normalizing interest rates, raising rates. We've seen that the U.S. economy has needed an increasingly lower level of real rate over years throughout the business cycle, and we think the Federal Reserve is going to go slow and not do anything to derail the recovery. Now, you're probably a bit more interested in the Chinese outlook. The main thing that we're concerned about in China is this very large rise in private sector debt, mostly concentrated in the corporate sectors. So we've seen non-financial corporate debt rise from 120% of Chinese GDP at the end of 2008 to currently 200% of Chinese GDP at the present time. Now, we'd separate China from the bulk of the rest of the emerging world, and India as well in that sense, in that it's got a very low level of external debt relative to GDP. So China and India, the lowest level of external debt to GDP of all the major emerging market economies. So emerging markets overall, excluding China and India to that regard, would take a much more cautious view. As a rule of thumb, we look to invest in emerging markets that are pursuing pro-growth structural reforms, and India would very much fall in that bucket. The Narendra Modi-led reforms, pushing away government involvement from private industry, encouraging foreign investment, and the public appears to largely be behind these reforms. So what we're seeing now from a cyclical perspective is fiscal spending in India decline quite sharply. And this, combined with the decline in commodity prices, is pushing down inflation in India. Despite this, typically when we see the fiscal balance tighten in India, so this is actually a separate way of showing fiscal spending. What we're doing here is showing the fiscal balance as a share of GDP. So as the blue line on this chart rises, that shows the government reducing its budget balance and it's essentially spending less. Normally that frees up savings for the private sector, and we see a pickup in bank lending on the back of that. But we're not seeing a meaningful uptick in bank lending in response to this decline in fiscal spending. Now, our view is that because of a non-performing loan issue among India's private banks, that's going to limit a meaningful uptick in bank credit demand, and that's going to limit a meaningful uptick in corporate profits in India. This chart here shows that since 2013, almost all of the improvement in India's stock prices, there have been a correction since the beginning of 2015, but almost all of the improvement until then had been driven by expanding valuation multiples. Earnings are broadly where they were at the beginning of 2013. So we believe that India is better positioned compared to the rest of the emerging market universe, but because we're cautious on emerging markets overall, we're cautious with regards to how much Indian equities can improve at the current time. But again, we would overweight Indian equities within the emerging market universe. Thanks very much.
Lovely insights there. Thank you for such a comprehensive overview of the global macro fundamentals. But at this point, we really want to focus the conversation on India and its continued relevance as an investment hotbed. And so to help us do that, the Chief Editor of Financial Markets, Mr. Nikunj Dalmia, please join us on stage.
Exactly a year ago, we were discussing Grexit. Today, we are discussing Brexit. So as we roll over from 2016 to 2017, what should we focus on? What do you think financial markets will be obsessed with?
I think, this in the background is going to be these big picture themes of we're in a post-debt supercycle world where potential growth is lower than it previously had been. And because indebtedness is still quite high, because productivity is coming down, because labor forces are shrinking. I think these are going to be key themes that markets are going to be watching closely. And I think markets are going to be watching closely the next steps that central banks do in the event that we do get a softening in growth, because we do have this view that implementing additional measures that have currently been implemented, so negative interest rates, additional QE, are no longer going to be as effective as they had been previously. So I think markets need to start thinking about the next steps that central banks can take. And we absolutely think that they have more tools at their disposal. Largely, I think the end game in some markets, particularly in Japan, once we do enter into a more negative economic backdrop in Japan, would be these kind of helicopter drop options.
What's your view on India? The most important question. What are the headwinds and tailwinds for India?
I think, the big tailwind behind India, as I mentioned, our rule of thumb is to favor emerging markets that are pursuing structural reforms. And I think, market sentiment around Indian structural reforms is pretty elevated. There's quite a bit of optimism in the global economy and the global financial markets around the Indian outlook. And I think absolutely it's going to be the economic bright spot in 2016 of all the major economies. I don't think any major economy is going to grow at a faster pace than India. I think that there is potentially some scope for disappointment in terms of structural reform in India. I think it's likely to move in the right direction, but expectations are quite elevated, so there's some scope for potentially a little bit of disappointment. But I think relative to the overall emerging market universe, we'd say that India is very well positioned from that standpoint. So I think that's something that we're encouraged by. But because we're very cautious on emerging market risk assets, while we think that India will be a relatively strong performer, we're not expecting to see absolute increases in Indian kind of equity markets like other kind of favorable regions in the emerging world. China would be a separate case.
But can India move independently of what's happening in the world? We've seen cases in the past. We've seen how Japan moved in 80s, how US market moved in 90s, what happened to emerging markets between 2001 and 2008. So can Indian markets really move independently because of the fact that we are in a great macro positioning?
Yeah, I think, India will end up being tied to what's happening in the overall emerging world. So given our view that the emerging world is in this period of weak growth, I think India will obviously be affected by that. So I think it's a relative bright spot in a universe that is sort of in this continued weak backdrop, so the emerging market universe in general. All right, thank you very much
with that.
Thanks.
Now that you've received a comprehensive global macro view, we thought that you stood to benefit from a bird's eye view of equity as an asset class. And to do just that, we have the firm's co-chief investment officer who spearheads equity investments at Birla Sun Life Asset Management Company. In fact, he's responsible for managing in excess of 37,000 crores in equity assets. Please join me in welcoming Mr. Mahesh Patil.
Hello friends, and welcome to this Equity Voyage. Welcome aboard on this journey, and I'll take you through Equity Voyage and navigate you through the turbulent and the deep seas of investment to the final destination, which is wealth creation for us. The environment, what we are currently, is pretty dynamic. it's not going to be a linear growth. There will be a lot of challenges. And we as portfolio managers need to really navigate through all these challenges. So if you compare investing when you're managing a portfolio, there are a lot of factors which impact that. A portfolio manager has to really look at various factors. It's not looking at a company alone, standalone, the fundamentals. He has to look at what are the market conditions, how is the liquidity, how is the fund flow trying to move in, how is the interest rate environment, at what business cycle one is in, whether we are in the recovering or we are in a down cycle. And also disruptions, if they are happening in a particular sectors. What we have seen, how disruptions are happening in the banking sector, with digital coming in the IT sector. So all these factors need to be considered before we actually invest into a stock. And that's where actually the skills come in. And alpha generation for us has been the key. And we have to manage all that, you have to be nimble-footed. Our return expectations, I think, overall for the markets in the current environment where we are, have to be moderated. But I think still equities offer a very strong potential to generate long-term returns for investors. And asset allocation is something which we talk about very often. It's something which we always recommend. You also, as advisors, talk to your clients. And it's very true at this point in time, when we want to have a very balance in our portfolio. As Manish will talk, and even the earlier speaker said, it's important to have a right balance in the portfolio of equity, debt, and other asset classes. While we've seen the markets the last 20 years, every past correction looks like a missed opportunity. Only the recent correction looks like a threat. I mean, that's been the kind of investor psychology, and it's been common across. And if you look at in the last 15 years history, we had the Y2K, which was, again, a new concept, when we moved from 2 digits to 4 digits, and that created a big crash. Then we had the global financial crisis. Then we have various terminologies like zero interest rate regime, negative interest rate policy. We had PIGS. So all these things which impacted the markets, and they were deep corrections. But looking back, if we had invested at that point in time, they only seemed opportunity. Even now, as we look forward, there are a lot of uncertainties which are there. There is Brexit, which is an event which is going to be in the next couple of months. You have helicopter money. But if you believe in what we have seen, in the longer term, what wealth creation, what we are able to do, we think these are opportunities, which should not be missed. And this is time actually to really invoke in all of us the Buffetts, the Charlie Mungers, the Peter Lynches of the world, and really what these investors have shown across market cycle, to really stick to your philosophy, stick with the longer term, and create wealth. And even while we board on this journey, the Voyage journey and Equity Voyage with us, it's important to really focus back on fundamentals so that we stay clear on the course for wealth creation and not deviate from that. So I think we are in a place where I think our journey is long-term, as one of these speakers mentioned, and the outlook looks good. One needs to stay focused and really benefit from it as we go forward. Thank you.
Now we'd like to switch gears and take the conversation to fixed income as an asset class. And to do just that, we have the Co-Chief Investment Officer of Birla Sun Life Asset Management Company with us. Please join me in welcoming Mr. Manish Dangi.
To begin with, let me emphasize this, that for about 2.5 years, we've stayed constructive on interest rates, and we've had this view that RBI would cut rates aggressively over 2-3 years, and it is a structural rally in markets. We've also stayed away from credit for a while. So let's review some of it and maybe look into the future as to how things would play out. But broadly, we think that most of the forces which were present when we built this thesis of bond rally about 2 years ago are still in force, and we continue to believe that bonds would continue to rally and rates would be brought down further in next couple of quarters and potentially even next year. On the credit side, you aware of our position over last 1.5 year. we've kind of stayed off the credit risk across our portfolios because we started to think very early that commodities were getting bubbly and it would have large influence on credit markets as such, and which is why we started to pair our positions across our funds from liquid to liquid plus to short-term to credit funds and dynamics of the world, pair our positions across credit. It's kind of paid off so far. But the point I want to highlight here is that the macro of credit actually continues to stay very, very weak. Largely because of the capital structure of lots of Indian corporate is still not in good shape, and the given kind of price of lots of commodities and the kind of growth that we have in our country, it would not be able to support a lot of these corporates' capital structure in the existing form, and which is why a lot of them will have to take big haircuts in future. But what has happened simultaneously is that the credit markets have blown up, the spreads have blown up, especially in the last 7-8 months. The spreads have near doubled. The A-grade papers, which were trading at 120-30 basis point, now trades between 250 to 350 basis point over AAAs. Frankly, in last 1 year, when AAAs have rallied quite meaningfully, the A-grade papers have actually, in terms of yields, have risen by 100 to 200 basis point. And of course, there are sectors, particularly in metal, the rise of yield has been substantially more, and which is why lots of funds that you would have invested, which had exposure in such toxic assets, you did have to pay a big price for it. But now, at least in generally, one could say that valuations have started to look attractive. So as a fund manager, then you're actually guessing what to do, because macro still not very conducive. But we've started to think whether if valuations are attractive, you could start to look at some of these assets. Now, what should investors do? FD as a destination or as a place to park your money has actually lost a big sheen. Of course, tax-frees used to be other instrument for HNIs and wouldn't be there next year. Your pensions or EPFO and small saving rates have been brought down and now have been linked to government bonds. So net, the traditional places where most of the fixed income money used to go, is actually not available for investors, and therefore, the only way that a smart advisor and an investor will have to, if he has to earn extra return, he'll have to negotiate with the markets and place his money in funds or something else in the market. But funds remain, of course, the most attractive destination place to be, and place his bets across various funds that we have in the MF industry, and optimize return for himself. Thank you.
Mahesh, this one is coming your way. You should have guessed it. If you ignore your role of a fund manager who's managing X thousand crores and just take an agnostic view, what do you think will perform very well over the next 12 months? Would it be the large caps? Would it be the mid caps? Or do you think the smaller end of the market will participate?
From a near-term perspective, the risk-reward in the large cap looks favorable. We have seen the mid-caps have done well in the last 2-3 years on expectation of higher growth. And mid-caps have delivered better growth. Earnings growth has been better because a lot of the mid-caps are domestic-centric. A lot of large caps are linked to some extent to the global growth. But the differential has expanded. So from a near-term perspective, if purely from a risk-reward perspective, and considering the fact that we have seen bouts of volatility and a sharp correction where mid-caps can correct significantly. But if you take a slightly longer-term view, because I understand the answer is for a 1-year perspective, you need to have mid-caps in a portfolio to generate alpha, because Indian mid-caps bottom-up story has been very strong, and there are pockets of growth domestically where the mid-caps have grown significantly at a higher pace than the large-cap space. So good stock picking capabilities and the opportunities which mid-cap can offer over the longer term.
What sectors should people look at?
I mean, consumption is something which we see a pickup of that coming through. The monsoons have been likely to be good, so that should boost rural consumption. The valuations in the sector are slightly on the higher side, so probably the stock returns might not be as great. But discretionary consumption, where I think the potential to surprise positively on the upside in terms of growth and the valuations, I think that's a sector which clearly seems to be top of the mind. Apart from that, I think while the banking sector has gone through a lot of challenges, and we might not see good overall growth next year. But we have seen the banking and financial services sector across the market cycle has done well. And as the asset quality issues go behind us, I think there is some value which is emerging over there. So that's a sector which I will be looking at.
Nish, a 5-word question and something that even I want to know. The best bond fund to buy.
Both duration and credit remain legitimate strategies to exploit markets that we see. There are headwinds for accrual space, credit funds, but you got to pick the right fund managers. Let's say a fund that I would manage hasn't seen a single downgrade in last 1 year. Forget about the guys who've seen defaults and so on and so forth in their portfolio. So maybe medium-term plan is the one I would look at. That's where very soon where we are invested our money would get disclosed on our website, and you will see a lot of my money being placed in medium-term of mine. And I also like the way I manage dynamic bond fund, and you kind of negotiate both duration and credit well. And it's unique fund in a sense that everyone else is, seems to have developed either duration or credit in terms of, how to negotiate with markets. And instead, what I've done in Dynamic is that through last 10 years, as and when I see opportunities in any of these, accrual or credit or duration, I try and exploit it. And it kind of has delivered reasonable returns over the last 10 years, but more importantly with a lot less risk than a typical dynamic or an income fund gives. So I would choose either of these two for my money, and that is what the recommendation is.
Gentlemen, thank you so much for joining in for this discussion, and I hope the audience has benefited from this little interaction that we've had with the two minds at Birla Sun Life. Thanks so much for joining.